Today, we're doing a forensic breakdown of one of the absolute most powerful tools in global business, Hong Kong's 0% offshore tax advantage. And look, we're keeping this strictly to the exact specifications, the operational realities, and the precise compliance hurdles you need to actually secure this benefit. No fluff, no assumptions, just the facts. Before we dive into the massive offshore tax advantages, let's talk about your global foundation. You absolutely cannot legally optimize your taxes or shield your international profits without a properly structured overseas entity. Most entrepreneurs try to hack their way through offshore setups or use sketchy, outdated tax havens, and that's exactly why they trigger audits, face heavy penalties, or get entirely blacklisted by global banks. Your business needs a legitimate, officially recognized presence in a top-tier pro-business jurisdiction that utilizes a territorial tax system. This means if your profits are generated strictly outside of Hong Kong, you could legally pay 0% in corporate taxes. That's where OSOM comes in. OSOM is the absolute best service out there for foreign founders, handling your entire Hong Kong offshore company formation 100% remotely. They take care of all the complex heavy lifting for you, securing your legally required local registered office, providing your mandatory company secretary, filing your incorporation documents, and ensuring your ongoing compliance everything you need to establish a legal, tax-efficient structure without ever stepping foot in Asia. This is non-negotiable if you want to operate globally and keep more of your hard-earned revenue. Check out the link in the description below for my full OSOM review, and be sure to use my link to get your Hong Kong company set up right through OSOM today to unlock exclusive discounts and perks. Section 1. The Offshore Tax Advantage. Let's talk about what this actually is. We're going to anchor our whole discussion right here on this primary metric, 0%. Under Hong Kong's tax regime, your company can legally pay a flat 0% tax rate on profits earned entirely outside of Hong Kong's borders. Now, you might be thinking, this sounds like a shady loophole, but it's absolutely not. It's a legitimate, legally backed feature intentionally designed to attract international entrepreneurs to use Hong Kong as their corporate base. The bedrock of this whole system is built on something called the territorial source principle. So what does that mean for you? It means the Inland Revenue Department, the IRD, only taxes profits that specifically arise in or are derived from Hong Kong. You can easily incorporate your company there. You can even operate a multi-currency Hong Kong bank account, but your taxation is based purely on where your profit-generating activities physically take place. But here's an interesting little detail. There's actually a built-in onshore safety net. Even if a portion of your profits is considered Hong Kong sourced, the system is still unbelievably competitive. Thanks to their two-tiered system, the first 2 million Hong Kong dollars of your assessable profit is taxed at a remarkably low rate of just 8.25%, and anything beyond that is capped at 16.5%. Section 2. Key features and claim steps. Let's get into the mechanics of how this works. Okay, so if you want to claim this offshore status, your operation absolutely has to pass the IRD's very strict operations test. Basically, you're looking for a binary no to this rapid-fire checklist. Do you have Hong Kong staff? No. Hong Kong customers or suppliers? No. Do you have a physical office or warehouse in the city? No. Are your contracts negotiated or signed in Hong Kong? No. Do your goods physically touch Hong Kong soil? No. If you hit no on all of those, congratulations. You've got the profile of a genuine offshore operation. So how do you actually execute this? Well, it's a pretty rigid 3-step chronological process. Step 1, you incorporate your legal entity in Hong Kong. Step 2 is absolutely critical. About 18 months after incorporation, the IRD issues your first profits tax return and you file it declaring 0 taxable income based on an offshore claim. Then comes step 3, and this is where the real work happens. The IRG is going to send you forensic inquiries. They will send incredibly detailed questionnaires putting your business model, transaction flows, and entire operational structure under a microscope. Now, we need to talk about a major recent shift in the compliance landscape. There is a huge difference right now between standalone SMEs and multinational enterprise groups, or MNEs. If you're an independent standalone company, you completely bypass the newly introduced foreign source income exemption, or FSIE regime. But if your Hong Kong company is part of an MNE group that operates across multiple jurisdictions, you're looking at some significant new compliance hurdles. Let's look closer at that. The FSSIE regime aggressively targets specific types of passive income. This went into effect in 2023 and expanded in 2024. Basically, if an M&E receives specified foreign-sourced passive income in Hong Kong, the IRD automatically deems it taxable. And the sources outline 4 exact types of income caught in this net: interest, dividends, disposal gains from selling assets, and intellectual property, or IP, income. But if you are an M&E, all is not lost. You can rescue that 0% tax rate on passive income if you hit some highly specific thresholds. There are 3 main pathways here. First, the economic substance exemption, which means you must have adequate human resources and physical premises right in Hong Kong. Second is the participation exemption for dividends and non-IP disposal gains. For this one, you have to hold at least 5% of the foreign entity for a minimum of 12 months, and that income must have already faced a foreign headline tax rate of at least 15%. Finally, there's the nexus approach, which ties your IP income exemptions directly to the actual physical research and development activity you conduct inside Hong Kong. Remember, for M&Es, meeting these is not optional if you want that 0% rate. Section 3. Real-world business applications. Let's see how this performs in the field. Right, let's look at a classic offshore trading structure. Picture a cross-border e-commerce or wholesale business. Your Hong Kong company buys goods from a manufacturer over in India and then sells those exact same goods to a distributor in Singapore. The crucial part here? The logistics. You use direct third-party shipping straight from India to Singapore. The goods literally never touch Hong Kong soil. Because the procurement, the sales, and the shipping all happen entirely outside of Hong Kong, you legally lock in a 0% Hong Kong tax margin on those trading profits. Now, what about IP licensing and services? Say you run a software firm. An Indian parent company licenses IP to your Hong Kong entity, which then sub-licenses it out to clients across the ASEAN region. As long as those license agreements are signed offshore and you aren't doing any development or customization inside Hong Kong, that licensing income qualifies as offshore. 0% tax. But listen to this carefully, because the sources are explicitly clear. If even one of your staff delivers consulting services from a desk in a Hong Kong office, boom, you instantly trigger the 16.5% onshore rate for that specific income. Another incredibly popular application is the investment holding setup. Private equity firms, venture capital, family offices, they absolutely love utilizing Hong Kong holding companies. Why? Well, dividends received from your foreign subsidiaries, 0% Hong Kong tax. Capital gains when you finally exit an investment, 0% Hong Kong tax. Plus, Hong Kong doesn't have any thin capitalization rules, which gives you the freedom to create highly flexible, highly efficient financing structures. Section 4, honest pros and cons. Time for the audit. So let's weigh this out honestly. On one hand, you have massive financial upside through total tax efficiency. On the other hand, you face the heavy operational burden of intense IRD scrutiny. You've got to understand, the IRD does not just hand this exemption out automatically. The entire burden of proof falls 100% on you, the taxpayer, to prove with meticulous records exactly where every single profit-generating activity happened. But man, the pros are absolutely unparalleled for a global business hub. Beyond getting that 0% offshore tax rate, Hong Kong has absolutely zero value-added tax, no GST. There is no withholding tax on dividends or interest paid out to non-residents. You can have 100% foreign ownership without needing any local partners, and you don't have to navigate any exit taxes or general controlled foreign corporation rules. It's incredibly streamlined. However, the cons bring some severe operational friction. First off, you're facing mandatory annual audits by a Hong Kong registered CPA, and that's regardless of where your actual operations are. Then you have to survive those multi-round, highly detailed forensic questionnaires from the IRD. If you're an M&E, you've got those complex FSIE substance requirements we talked about. And the biggest risk? If your deal-level record-keeping is sloppy, the IRD will straight up deny your claim, and you will be paying taxes. Section 5, Final Summary and Verdict. Our sources make the reality of this situation crystal clear. Successfully leveraging this benefit in today's environment is absolutely not a DIY project. It's a highly potent tool, for sure, but it requires professional structuring and flawless execution from day one. You can't just set up the company, run things loosely, and then hope to figure out the tax claim a year and a half later. If you want to survive an IRD field audit, the mandatory requirements are non-negotiable. You need genuine commercial substance, meaning your daily operations actually have to match the offshore structure you claim on paper. You need meticulous deal-level documentation for every offshore profit, down to the invoices and shipping records. You've got to use arm's-length transfer pricing if you're dealing with related entities. And you must maintain consistent annual compliance, because the IRD is always watching. So the ultimate question you really have to ask yourself before you go down this road is this. Can you definitively prove exactly where every profit-generating action physically took place? Literally, if a founder signs a business contract while sitting on the edge of a bed in a Hong Kong hotel room, the IRD will view that as an onshore activity. Your operational readiness and your documentation simply have to be bulletproof. Which brings us to our final takeaway. The 0% offshore advantage in Hong Kong is real. It exists, but it is reserved exclusively for businesses with genuine international operations and flawless compliance. Think of it like a high-performance tax engine. It requires expert handling to keep it on the track. So, the question you have to answer is, are your global operations truly structured to capture this 0% reality, or are you just one IRD audit away from a major tax bill?